You know, there's an invisible war happening in the financial markets every single day. And if you're a trader, guess what? You're right on the front lines, whether you realize it or not.
Come on, you know the feeling, right? You've done all your homework, you've analyzed the charts, you spot what looks like the perfect trade, you follow all the textbook rules, and then, boom, it just blows up in your face.
I mean, this quote just nails it, doesn't it? That moment that makes you want to throw your monitor out the window. The price dives, hits your stop loss by literally a single tick, and then, like magic, it reverses and skyrockets exactly where you knew it would go. But listen, I need you to hear this. You're not imagining things, and it is not your fault.
Because the truth is, what you're experiencing isn't just a string of bad luck. It's not a bug in the system. It's a feature. The market is literally engineered to do this. Okay, so let's pull back the curtain and find out why.
So, the heart of this entire war comes down to one single thing, a relentless hunt for something called liquidity. And there are two very, very different sides fighting over it. On one side, you've got us, the retail traders. We're all reading the same books, watching the same YouTube videos, learning the same patterns. And that makes our behavior incredibly predictable. On the other side, you have smart money, the giant banks, the hedge funds, the institutions. And here's the kicker. They are not playing the same game as us. For them, our predictable support and resistance lines aren't safe zones. They are targets. It is a classic predator and prey dynamic, plain and simple. Okay, so you gotta put yourself in their shoes for a second. The big institutions have a massive, massive problem. How in the world do you buy or sell billions of dollars of an asset without your own order completely wrecking the price? If they just smashed the buy button, the price would shoot up and they'd get a terrible fill. So they have to be clever, they have to be sneaky. And that is where liquidity becomes the name of the game. Just think of liquidity as a giant pool of buy and sell orders. And where's the deepest part of that pool? Where are all the orders clustered together, just waiting to be filled? You guessed it. Right above the obvious highs and right below the obvious lows. Exactly where we've all been taught to put our stop-loss orders. For them, our stops aren't a safety net. They're the fuel they need to get their own business. And this image right here shows the hunt perfectly. This is a textbook liquidity grab. You see how the price is intentionally pushed just above that clear resistance level? That does two things at once. It tricks all the breakout buyers into jumping in with FOMO, and it simultaneously triggers all the stop losses from people who were short. And once the institutions have absorbed all of those orders, the trap is sprung, and the real move begins in the complete opposite direction. Now get this. This isn't some rare, random event. It's so predictable that it happens like clockwork, every single day during a specific event called the London Fix. Think of it as a magic trick that the market's biggest players perform every day. It's a grand illusion, a performance of misdirection designed to make millions of traders look one way while the real move is happening somewhere else entirely. And like any good magic show, this one has a scheduled start time, 4 p.m. London time, every day. This is when major banks set benchmark currency rates, which means they have to execute enormous orders in a really small time window. And that creates the absolute perfect conditions for a massive fake-out. And here's the wild part. A 20-year study of this event found that it follows a repeatable script. It's like a 5-act play. 10 minutes before the fix, algorithms start probing, sniffing around for clusters of stop orders. 5 minutes before, volume surges as the big institutional orders get queued up. Then, at exactly 4 p.m., you get the fake-out launch. Price bursts through key levels to grab all that liquidity. But just 2 minutes later, the reversal begins. The trap is sprung, their orders are filled, and the whole move collapses. And we're not talking about a coin flip here. The data is absolutely staggering. That study found that 73% of the time, breakouts that happen around the London Fix are false. They completely reverse. And if you trade gold, it's even higher, an 82% failure rate. These are not random market wiggles. This is a statistically recurring, engineered event. In fact, these tactics are so common, they've even been given names. You've got the head fake hustle, where price breaks one way only to snap back hard in the other. There's the liquidity void, which is a sudden, violent spike through a thin part of the market. And then you have the gamma trap, a more complex manipulation tied to the options market. And believe me, these are just a few of the plays in their book. So, how do we stop being the victims here? How do we flip the script? Well, the good news is, these institutions, they leave clues behind. They leave footprints all over the chart. We just need to learn how to read them. The first and maybe the most important footprint is something called an order block. It's simple. Look for the very last down candle right before a massive explosive move up, or the last up candle before a huge plunge. That single candle is incredibly important because it's where institutions likely absorbed all the opposing pressure to load up their huge positions. That spot becomes a magnet for price. Now, the second key sign is the market structure shift, or MSS. This is your confirmation signal. So after the price raids a liquidity zone, let's say it dips below an old low, it doesn't just drift back up. It reverses with force, aggressively breaking the most recent swing high. That powerful break is your signal. It's the market basically screaming that the raid is over, the trap has worked, and the institutions are now in control, driving price the other way.
Okay, so when you can spot these footprints, everything changes. You can stop playing their game and start playing a new one where you're trading alongside them, not against them.
Here's a simple framework. Step 1, find the liquidity. Identify those really obvious highs and lows on a higher time frame. Those are the targets. Step 2, wait for the raid. Be patient. Let them make their move and don't get faked out. Step 3, get confirmation. You need to see that powerful reversal and that market structure shift. And finally, step 4, enter on the footprint. Don't chase the price. Patiently wait for it to pull back to that order block you found, and that's where you look for an entry. I want to leave you with this one thought because it perfectly encapsulates everything we've just talked about. If you can't spot the liquidity, you are the liquidity. The whole market revolves around this hunt. By learning to see where those pools of orders are, you stop being the target. You start to see the market not as something random, but as a deliberate, engineered game. And the only question left is, which side are you going to be on?